Hello everyone, Abdurrahman is my name. So we are still on mathematics of finance and we are talking about today annuity. What is annuity? An annuity is a given sum of money payable or receivable periodically into the indefinite future or over a specific period of time. An annuity is a given sum of money in which you receive indefinitely or over a period of time, as simple as that. For a very good example of annuity is what? Is our weekly wages. Workers in the company, in the factory receive what? Weekly wages. Staff of a company receive what? Monthly salaries, or probably your insurance premium. The money you pay for a particular insurance policy you hold, which do what you have, is a form of what? Of annuity, because it's a continuous money in which you normally pay at the end of at the end of a particular period of time, either monthly, quarterly, yearly, or as the case may be. So that sum of money in which you are paying into a particular into the future indefinitely or for over a period of time which you have agreed upon is known as annuity. In that case, therefore, what are the types of annuity we have? We have ordinary annuity and annuity due. So from here, what we are trying to do to ascertain is for you to do to know how much your money will be at the end of the period in computing that. Alright, by computing anyway. So we said we have types of annuity. We have ordinary annuity and annuity due. When we say ordinary annuity, it means a payment or receipt at the end of the payment or receipt interval. Take for example January to December. When you are paying such a money, when you are receiving such a money, at the end of that payment interval, it is termed as ordinary annuity. Take for example yearly. The money you are paying yearly. If you are paying this money and you are receiving the money at in December, at the end of the year, we term that as ordinary annuity. Or if you are paying, as the case may be in the case of insurance premium, if you are paying it at the end of the payment interval, say December of every year, it is known as ordinary annuity. But in the case whereby you are paying it at the beginning of the period, whether at the beginning of the month or at the beginning of the year, it is termed as annuity due. Okay, having said this, let's now look at a particular question to do exemplify what we have been talking about here, to practicalize what we have been talking about here. Okay, let's go. Let's look at the question. Let's look at it. Let's look at the question. Okay, let's look at the question. This is the formula to use when you are talking about when you want to compute question on when you want to solve question on annuity. So the annuity factor is 1 minus 1 plus r raised to power minus n, everything all over r. That is the annuity factor. Where r is equal to, okay. So what will now be the value of the annuity at the end of the period? So present value to now be what? Pay 1 minus 1 plus r raised to power minus n, everything all over r. So what we have done here is just we have introduced A to this one, to this formula here. You see have 1 minus open a bracket 1 plus r super minus n all over n. You see have it here. So this is the present value. This is the future value in which you want to know how much is going to what. Okay. So we are trying to do what now as financial managers we tend to do what to give premium for risk. Of course, so we tend to do what to know the value of our investment in long what we're going to receive to know the present worth now. Okay, so in that wise, therefore, this is the annuity factor, and this is the present value of annuity. If you want to compute it, present value. So let's now look at this question. E.g., Mr. Olu has just started a professional exams. He needs about 200,000 naira yearly for 4 years. At present, the interest rate is 22% per annum. How much must he set aside now to meet his yearly obligation? Okay. Yes, there is it. Mr. Olu has just started the professional exam. He needs about 200,000 naira yearly for 4 years. At present, the interest rate is 22% per annum. How much must he set aside now to meet his yearly obligation? You can see, we said he needs about 200,000 naira yearly. Can you see? When we define annuity, we said annuity is a sum of money in which you receive or you pay indefinitely or at an agreed period of time. So this guy is now, Mr. Olu, need what? 200,000 naira for what? For 4 years. 200,000 every 200,000 naira for what? For 4 years. At least for every year you need what? 200,000 naira. So how much will you now need to do what to set aside now if you can invest? If the interest rate on any investment is what? Is 22%. So let's now look at it. So this is annuity factor, and this is what? This is annuity, the present value of the annuity. So present value is equal to what? A 1 open bracket 1 minus 1 plus r raised by n everything over r. Now let's now solve the question. Let's solve the question. With this, we already have the formula. Okay. So PV is equal to So what is it? 200,000, and the future amount which it means 200,000. Our A here is 200,000. Open a bracket. 1 minus, open another bracket. 1 plus r raised to the power minus n. 1 plus r. 1 plus r. What's our r? Our r is what? 22%. That is what? Okay. Let's say 1 plus 22%. 0.22 raised to the power minus n. What is our n? Our n is 4. Number of years minus 4. Okay. You close it. Close what you have opened using this. Okay, everything all over r, that is 0.22. You close it. How you can close it. Okay, so our PV, present value of what is going to invest now, or what is going to invest is what? So present value means present value. I mean what is going to invest in order for you to do or to meet up the obligation. So we have 200. Okay, so first of all, expand this. So we have 1 minus 1 plus 1.22 raised to the power minus 4. Okay, everything all over 0.22. Okay, we have 200,000 multiplied by. So what do we have? Let's expand this. 1.22 raised to the power 1. Okay, 1 minus 1.22 raised to the power minus 4. Let's bring out the calculator and let's solve for that. 1.22. So bring out the calculator and solve for it. 1.22 raised to the power minus 4. You have it to be 0.451. 0.451. 0.451 all over everything all over what? 0.22. 0.22. Okay, I think this can go now. Okay, 0.22. So 200,000. Open a bracket. Okay, so what is it? 1 minus 0.451. Okay, no. Okay, 1 minus 1.451. So divided by 0.22. Okay, so we have it to be 2.495. 2.495. So what do you have? 2.495. We have approximated to what? To 3 decimal points. 3 decimal points. So we have 2.495. So let's now do it. So 200,000. 200,000 multiplied by 2.495. We have 499,000 naira. So this is what is going to invest now. This is what is going to invest now in order for him to do or to be able to meet his yearly obligation of withdrawing what? 200,000 naira every year for him to do what? To meet up his obligation. So you have to invest 499,000 naira now, which will be giving him what? An interest of what? Of 22%. By that, he will be able to do what? To withdraw 200,000 naira on a monthly, on a yearly basis in order for him to do what? To complete his professional exam. So these are practicable questions in which we as financial managers, students preparing for examinations, in which we can appraise ourselves, in which we can test to know, to measure, to know how to plan our finances. These are practicable questions. These are practicable which we can apply on our daily activities. Being a financial managers, being a student, preparing for examination, being an entrepreneur. These are what you should be doing in order to do what to know to plan for your finance, to manage your finances efficiently. With this, we have come to the end of today's class. And if you have not subscribed to this YouTube channel, kindly click on the subscribe button and do what? And subscribe. And if you enjoy what you are seeing, kindly give it what? A thumb up. And also what? If you have any comments, put it in the comments. Put it under the comments, and I'll be glad to do what? To receive your comments. So thank you very much. Till we meet next time. So Abdurrahman Nadiri is my name again. Thank you.